as investors anticipate the Magnificent Seven will live up to their sky-high expectations. And with earnings seasons well underway, our next guest believes quarterly results from Microsoft and Alphabet could change the course of what is currently a weak earnings season. He joins us now, Michael Arone, Managing Director of State Street Global Advisors and Chief Investment Strategist. All right, so Michael, if we're in a weak earnings season right now, what are these companies going to say to turn things around?
So I think what's happening here, Brad, is that the Magnificent Seven expectations for earnings and revenue growth are sky high. So if these companies are able to surpass those very high expectations, I think this will continue to drive the market higher. The risk here is that they are priced for perfection. Valuations are certainly stretched from that standpoint. So I do think that this is kind of a high risk, high reward scenario we're under, and Microsoft and Alphabet are going to set the tone after the close today. So again, if they are able to beat those high earnings expectations, expect some more positive momentum for stocks for the balance of this week.
Michael, what are you anticipating? Because obviously the debate out there on the street is how much more room a lot of these tech giants, the leaders of 2023, have to run here in 2024. Where are you seeing that investment opportunity?
So from our perspective, we still like the technology sector. We like the fact that earnings momentum continues to be quite strong. Price momentum continues to be quite strong. We like the AI phenomenon. We believe that it's real. It will drive productivity gains. It will drive sales gains from that perspective. So despite the kind of rich valuations, tech has a lot going for it. We still like technology. But to balance that out a little bit, we do like energy companies, and we also like industrials. So from an energy perspective, we think this multi-decade transition from fossil fuels to something else is likely to keep the supply of energy low, add in the geopolitical flare-ups, the fact that the companies are cheap and generating a lot of cash flow, returning that cash to shareholders is favorable. And then ultimately, industrials are actually growing their profit margins at a time when most are shrinking. We think this is a good sign as well.
Okay, like energy, like industrials, what are the parts of the market that you wouldn't touch with a 10-foot pole right now, Michael?
Well, our base case is for a soft landing, and that's what the data suggests we are headed towards in terms of that trajectory where the economy is moderating, inflation is inching closer to the Fed's 2% target, the consumer businesses are in reasonably good shape. Sure, they're off their peak levels from at the height of the pandemic when stimulus was at its height, but good shape. So with that soft landing scenario kind of being our base case, we're reluctant on getting too defensive. Your staples, your utilities, from that standpoint, our view is that that's too defensive positioning for a year that's likely to look okay from an economic perspective and from an earnings perspective.
Michael, are you expecting to hear anything from Jay Powell tomorrow that's going to change the narrative out there on the street? Because there has been a lot of optimism. Many guests that we have, many strategists that we have talked to over the last several weeks and really several months at this point, saying that the market is still way too optimistic about the number of cuts that we are going to get from the Fed before year end. Do you think we're going to hear something from Powell tomorrow that might change that narrative just a bit?
I was certainly surprised at the pivot in December, the move away from 2% is the target. We're headed to 2%. We're committed to get there, to all of a sudden talking about rate cuts. So I do think what he has to say tomorrow in the post-FOMC presser will be interesting. I expect, given where the economic data has been, what the market reaction has been to that data, and some of the kind of inflation figures still being above that 2%, I think he's going to try to talk tough and warn markets that it's still a bit too premature to be talking about, to be thinking about, and penciling in rate cuts. So it'll be interesting to see how they react to that. 10-year treasuries certainly have climbed this year. That's been unexpected to reflect kind of that more robust economic environment. And perhaps that some of these rate cuts are getting pushed farther into the year. But I do expect him to talk tough. So I think the surprise here would be if, in fact, he's more dovish. And he does suggest, hey, look, inflation actually is cooling much quicker than we think. At these levels, we're too restrictive. We need to start cutting rates. That would be the surprise, in my opinion.
Okay, so with that being the surprise, then what you were just mentioning a moment ago and them wanting to come out, seeming and sounding tough, then does this seem to you like a Fed that is at all satisfied with what the market is looking at in a 6-month average of us getting to that sub 2% target?
I think the Fed is likely to believe that the market's getting a bit ahead of itself in terms of pricing in those rate cuts and also kind of from a price perspective. So that's why, Brad, I do believe that Chairman Powell is likely to talk tougher and be a bit more hawkish than perhaps some are anticipating, because I think that they're probably uncomfortable with the fact that the market was pricing in so many rate cuts this year, so much in terms of monetary policy accommodation. And so I think that he's probably going to have to strike a balance to offset some of that, which is why I think he'll talk a little bit tougher. There's also this kind of underlying thread here, and rumors are now kind of being bandied about them slowing or stopping quantitative tightening. And so I think that'll be another area of focus tomorrow in terms of the Q&A. It'll be interesting to see what he has to say about the future of quantitative tightening. So I think markets may be overlooking that a little bit as well.
All right, Michael Arone, great to get your insight. Thanks so much for joining us here. State Street Global Advisors Chief Investment Strategist.